problem, I should say, number 4, given for homework. And the net identifiable assets at fair value is 48,000. And notice that the cash price paid was there. So the assets they identified was were at 40,000. The cash price paid was 54,000. So they paid 6,000 more than the identified. So this is the goodwill, or sometimes called the unidentified assets. And coming down here, the only tricky one other than that is depreciation expense. Because notice that when we add this 4,800 to the building's 10-year life with this 4,800, down here, notice that they're depreciating it based on a lower amount. So we have to bump up that amount and then also bump up the expenses. Now, after 10 years, it's going to go away. So we're not going to do that forever. But for the next 10 years, we're going to depreciate a little bit more out of it. Question on that? And these are the totals you should get for it. 206,000. A couple sneaky ones that that are the ones that people a lot of times forget about. When I say people, I mean myself also. Are the equipment, and don't forget about the goodwill. So if you're doing this on a test or something and you can't get it to balance, look at those two. This one sometimes sneaks in there, and this one also. Okay, question on that? Okay, so what we're gonna do, we're gonna finish up the handout today, and then we'll turn this thing in, and then we're gonna do a couple problems out of the book, which I sent out. I don't know if you guys are still having this problem, or if it's just mine. I think I have an idea that it's an overall problem, but the numbering in the books is still way off. all the bigger problems are labeled problem number 1, which, well, it sounds funny and it's it seems like it'd be trivial. It makes it impossible to assign problems out of the textbook. I can't just say do problem 1. You'll say, well, which problem 1? There's 34 problem number 1s. So anyway, so we'll do those too. But let's go ahead and finish up this handout, and then we'll move on. What's on sheet 2? What is that? Oh, okay, something else. All right. So to get the net assets at fair value, 22. Take the total assets at fair value. Hey, how come that's not centering? And then we also have to take into account these two liabilities at fair value. I will put those in as a negative because they're going to have to be paid out eventually. They reduce our Okay, so let's make that about darker than we wanted. That's too light. Darker. Okay, so cash price paid was that. And so the goodwill was 50, so the goodwill or unidentified. And we'll do the depreciation right now, just to get it out of the way. Since that's an excess building. Oops. Okay. So we will start filling this in. Let's see. So Sadie. By the way, you can't see this is at book value. You'll notice that the assets at fair value were not assets at fair value were 6,000, but that's with this $900 worth of excess. Take that $900 worth of excess out, you be back to the book value. Should be the 5100. Should probably color those. A is for assets. We have 2, land. No, we have 3. Land, building, and what's the third one?
Goodwill.
Yep. Goodwill is 750. Commonly forgotten about. We need a number for that. Oh, what am I doing here? This isn't right. One of those is wrong. The building should be 600. That should not be 0. Probably figured that out, I assume. It's kind of rare to make a journal entry for 0. Point to it. Okay, so Sadie, we now have to get, oh, I didn't put the Sadie up here. So Sadie, we have, so now we have D, the dividends. Kind of an unusual one in that it, oops. It's the only one that gets added back into the investment because it was subtracted out earlier. So when we're kind of unmixing all this stuff, we got to add that one back in. The income has to come out for the investment. Hey, you already have that one. Hold on.
How about the expense? Are we missing the expense?
Yeah, we gotta put the expense in. So the expense would be 60. Oops, let's try that again. And so this, we added 600 to it, but now we have to take 60 off of it. Use it for 1 year. That's it, right? Let me do my Sadie. SADE. I think we're good. And again, this up here, the total income, net income should not change at all for the parent company. Now, the revenues and the costs and all that'll change because you're taking 2 companies smashing together. But we've actually already accounted for the income of Bill Company. 630 minus the 60 would come to that. So we've already accounted for the income of it. So the net income here isn't going to change. It's just it'll be the same. Now the totals will be different. And I'm going to put this in as a negative. Same thing here. We got that. Plus that. Plus. The rest of these are the zeros. You don't have to put those in as negatives, as long as you subtract them out and get this for the net income. So the two net income numbers here, these should be exactly the same. The sales and that'll be the different. Sales and cost of goods sold and all that'll be different. But the net income should be exactly the same. And coming down here, basically the only thing that's going to be left, the beginning retained earnings is gone. This net income is gone. We canceled out that up here. And the dividends are gone. So really, this is just going to be whatever the parent company had on their books. And put this in as a negative. All right. Okay, so I'm gonna check the building hand just to make sure I did that right. That's right. Hold on. Yeah, that's right. Okay. Coming down here now, this is the problem one. So we have equal investment. Now the income gets added back in, everything else gets subtracted. And that should come out to 0, and it does. And again, the reason why we want that to come to 0 is that, you know, it really is this entire bill column is here. If we were not to take this out, it would double count the bill investment, because all Bill's stuff is included in this over here. Oh, I didn't add them up. Hold on. And equipment and goodwill are the two that are commonly missed on the handouts. Okay, coming down here, we pick up the liabilities. And then the only thing left is the parent companies. Question, I think. Okay, so we are finished with the chapter 3 handout. So I'll put that into assignments. Any questions on problem 4 or 5? And again, but part of the reason why you'll notice that those are very repetitive, and it's just to get down kind of the process of it. And now we're going to go to a couple of the book problems that are a little bit different, and which is good, you know. And now we're going to kind of try to apply what we've been going through here. And I'm going to go. I gave it to you guys in 3 send the whole thing out? I did. Oh. Well, you guys get more stuff. Shoot, I didn't mean to do that. All right. You know what it is? I used to have these as part of the handout. We're not going to do, oh boy, we're not going to do number 327. We could. 327 is actually one that I adapted to make into a spreadsheet. It actually isn't a spreadsheet in the book. But yeah, okay. So let's take a look at the. So this is the Excel one. If you're in the Excel one, make sure you go to text problem 328. It's also in Excel, no, Word and PDF file if you want to use those also. And by the way, there's nothing wrong with doing them by hand. When I go through these before class, I do them by hand. There's nothing, absolutely nothing wrong with doing them that way. I don't know. I like doing it that way. It flows a little better. Now, say, well, why don't I do it by hand like with the document camera? Because it's very hard to read. So that's why we don't do it that way. My handwriting was better, then we can do it that way. Okay. So this is problem 328. And they bought 100% of the company. The cash paid was this. The carry amount of the asset, so this is at book value. This is book value of it. And over here, we have the fair values of the assets. So here are the excess assets. So what is the excess for the trademarks?
$100,000.
Yeah, yep, 100,000. Customer relationships. So it was 0, now it's 75. So can't do that in your head. The equipment is kind of an unusual one. Not what we're used to. What's different about the equipment?
The fair value is lower than the book value.
Yep. What is it? Minus 30? I think it's 3,000. Minus 3,000. Oops, not enough zeros. So notice this one is, the book value is higher than the fair value. Now you may wonder, why is that? It happens oftentimes when there's newer equipment and you're using the straight line method, especially. For instance, you buy a car, your biggest drop in fair value in the value of your car is going to be, the market value of your car is going to be when you drive it off the lot, right? It goes from being a new car to being a used car. So that first year you take a big chunk of depreciation and the fair value of that car drops down quite a bit. Now, if you're using the straight line method, it just says everything, depreciates at the straight line. So if they actually have newer equipment, even though it sounds like it's bad, oh, gee, look at their equipment's on the books at higher than it is. that actually may very well indicate that it's newer equipment and that it just hasn't, been depreciated enough to more mimic the market value of it. Okay. So here's the book value of the assets. These are the excess assets. So see if you can figure out the goodwill. And I'll do the same. So how much is goodwill? If you think you have it, yellow up the answer. Or put it in chat. You can put it in chat if yelling isn't your thing, we can put it in chat. So these are the identified assets. So how much is not identified? Excuse me. So we have the book values. We have the excesses. Well, two of them are excesses and one of them is a deficiency or whatever you want to call it. So what is for the identifiable assets? What was the amount that we bought? How much did we buy here of identifiable assets? Anyone? I'll give you a hint. Look at the stuff that's highlighted in purple.
Is it 205? I don't know.
I think you're kind of on the right track. This would be, it's sort of like this. So this is the book value of the three, there's the three, whatever. Hold on a second.
See? Right.
So this is the book value. Now, these are the amounts that are going to bring it up to the fair market value.
Right.
So this will be the fair. And assets, or assets at that fair market value, however you want to put it. Okay, so if we add all these up, I'm gonna add these up. Hopefully it'll do this. Yep. And I'm gonna change this a little bit. So this fair market value of the net identifiable assets. So the stuff we could identify, there's 495. We paid 550. So how much of it must be goodwill or unidentified is maybe another way of putting it.
55,000?
Yep, very good. Messing up my here. Yeah, so hold on a second. So the cash price we paid was this. So goodwill must be the difference between those two. So 55,000. So this would be the goodwill. Make it a little brighter. How about? There we go. Okay, so I think, oh, we should probably do the expense, the relationship. So these relationships, by the way, it's very common to have customer relationships or sometimes customer lists be a very big part of a merger. If someone buys out, for example, like a landscaping business, the actual assets, some lawnmowers are worth a few bucks and all that. That's not really where the value is. The value is in the customer list that these are people you can go do, do the landscaping and you get paid from them. That's the real value, are those customer relationships. And that's, especially with the smaller companies, that's a lot of times that's the biggest thing. And if you go into accounting, if you buy out, say, another CPA firm, that's basically what you're buying out. I mean, they may have a few computers in the place, but those are a couple $100 or something. But you're basically buying out that customer list. So a lot of times it's a pretty big part of when you buy out another business. Okay, so trademark, indefinite life. Trademarks, as long as they keep renewing it, they can renew it for a nominal fee. I think it's every 10 years. So for instance, Coca-Cola, they're never going to let that trademark go. So they just keep renewing it every 10 years. And if you plan on renewing the trademark, it has an infinite life. You don't ever depreciate it or amortize it. Customer relationships, however, don't last forever. So we'll divide this by 5 years. I don't know how to put this. Same that divided by 5 is 15,000, I think. Hey, it's not formatting right. And this is divided by 10 years, but now we gotta be careful on this one because this is. Let's copy this down. You know, this is negative, so this will actually be a negative expense of what, 3,000? It'll reduce our expenses by 3,000. Kind of a weird one. Okay, well, let's see how this thing all works out. So the assets and the expenses are going to be kind of wacky on this one. All right. So let's do the stock first. Now you'll notice that they don't have any additional paid-in capital on the stock. Some states require a stock to have a par value, some states don't. So if the state doesn't require to have a par value, you know, whatever value you sold the stock for, that's the total amount. So there is no additional paid-in capital, so this will be stock. Retained earnings. Oh, how weird. I don't know what I did with this spreadsheet, but for some reason, a lot of these are coming up as New Times Roman. They're supposed to be all be Arial. And this will come out of our investment. Now the investment's in a little bit different place. It's up here. Okay. Let's go to the assets. Now the assets are going to be a little quirky. We got 100,000, 75,000, and minus 30. So we'll go trademarks, customers. So 175,000. Okay, so coming down here, trademarks. Customer relationships, it was 0. Now it is 75,000. And the equipment is negative 30,000. So what are we gonna do with that one?
Credit it.
Yep. Oh, goodwill. We say it was 55,000. Okay, so we come back here to the investment in O'Brien. Plus, 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 minus for the credit. And you notice that's what we paid for it, right? 750,000. So those two together are the 550. Now we have to unmix the dividends. The income has to be taken out. Okay, now for the wacky part. This 15,000 is going to be an amortization. Amortization is something you do when it's not tangible. This one will be depreciation. Oops. Okay, so let's take the easy one first, the amortization. So the amortization expense is going to go up by, oops, by 15,000. Get a color for these. Have I used orange yet? Yeah, I did. I'm going to reuse purple. Okay. Okay, so the amortization expense for 15,000, so that's for the customer relationships. And now for the really wacky one, this depreciation expense. What are we gonna do with that? For the income statement, what are we gonna do with it? So we debited the 15,000 amortization expense. Now this depreciation expense, remember, we now have decreased the amount of equipment we have, so we're gonna have a lower depreciation expense. So what are we gonna do with that one?
Credit it.
Yep. So we're actually gonna reduce our depreciation expense. And coming down here, this will reduce the amount of, oops, let's try that again. Our discrepancy in our, and eventually, like say over the next 10 years, it'll go down to 0. Yeah, so this is the wacky one here. This is the unusual one. Okay, well, I think we're ready to start putting these together. Okay, now remember this one, you're gonna say 75 plus the 70 minus the 3. And it's a negative. Oh, wait a minute. Hopefully this will come out to be 935. Hey, hey. This one will be exactly the same as over here. By the way, these 242 negative 142,000 are an unhappy coincidence. They're just okay. So in the assets, you add the debits, subtract out the credits. hopefully this one will go to 0. Yay. Okay, liabilities, looks like they just put all the liabilities together here, so. And these will be just the two parent numbers. And I really hope these balance. Oh, no, it doesn't. What happened? Oh, wait. Hey, it does. Yay. And so this is what this would look like, for the consolidated financial statements. This is all you'd see. Yeah, you probably wouldn't see this in there, obviously, but. Okay, let's go ahead and take a break. You bet. What time
Can you
is it?
leave that up? I'm like
Absolutely.
moving really fast today.
No, no,
I
no.
mean, really slow, I mean.
Well, I mean, by the way, just so you guys know, if I'm going too fast, you gotta tell me, because it's hard to know.
Just
I'll leave this
give me
up.
yeah.
Okay, and I will, let's say, how about be back at. Let's say 7:15. Yeah, there's a lot there. Yeah, so the, hold on a second. Yeah, so these will all be added and this will be subtracted. to get-
Just want to make sure. I guess I missed that part.
Well, it's a weird one, because the excess assets is actually negative. So.
Right. That's why I figure because of the negative part. Okay.
Yeah, it's kooky.
Thanks.
Yeah. One of my favorite fortune cookie things I always bring up is I got a fortune cookie one time that said there's no such thing as an ordinary cat. You know, they're all and the same thing is with companies. They're all companies. There's always something wacky with with companies and with whatever you're working on. And every single company is different. Walmart, Walmart and Target are in the same market pretty much, but they're different. They sell different things, they do things differently and all that kind of stuff. So, there's no two companies that are the same, and almost all of them will have some kind of quirk to them. All right, well, I think we'll go on to problem 3-33. Should be able to finish this one. Now, this one is a little bit different in that we have this down here, this gain on bargain purchase. Oh, let me zoom in a little bit. So what has happened here, this is sort of the opposite of goodwill. In my time, they called this bad will. This is when you actually buy it for less than the identifiable assets. Now, to be quite honestly, that would be a big incentive to buy it. So one of the guys in I think I told you I went to a merger seminar one time just because I was bored at all the other seminars they had, and we had to get CEUs, which are to keep your license and all that. But anyway, the one guy was saying that goodwill is bad, bad will is good. Bad will means that you paid less than the assets are worth, which is what you want to do. So that's kind of this situation. So I'm going to move this over So if you look at this Chandler company, they have a book value of $1,105,000, but their patent technology is undervalued by 204. Let's go to the yellow. So net fair value. Okay. So net identifiable assets at fair value would be those two together. Now notice that they paid $1,183,000 for assets that are worth 1,309,000. So they got more assets, identifiable assets, than what they paid. So this is when the bargain purchase comes in. That they, let's see here. This is what it's worth. That's what they paid. So that's that bargain purchase. Now, that bargain purchase is a one-time deal. This just happens that with the year that you buy it, you put it on the books as a bargain purchase. It's one of the really weird things in accounting in that you recognize a gain when you buy something. That's usually not the case. Usually that's a big no-no. But in this case, when you buy it, you got more assets than what you paid. You take it as a gain. It'll be gain this year. You'll never see that gain again. It's just a one-time deal. And everything else just goes on the same as it did before. So we're not going to really do anything with that gain other than add it into our income. But it's again, it's a one-time deal. It's unlike goodwill that goes on forever. This is one time, and then it's taken care of, and then you'll never see it again. Okay. So I guess we can do the amortization for the technology. Let me if I do that. And I'm going to move this up. Is what I'm gonna do. So in 6 years, oops. Hey, how come you're not going to some? So 204,000 divided by 6 equals some number.
34,000.
34. Hey, yeah, I got it. Okay, so I think we can start going through here. The rest of this is actually fairly straightforward, I think. All right, so I know what I'm going to copy over. Do I have it here? I don't have it here. I'll copy over the Sadie thing. Okay, so stocks. Okay, so that's 105,000. Actually, that should be the same as, yeah, that's that 105,000. That's the book value of it at acquisition. Okay, assets. We have patent technology account undervalued. So, okay, so we have to 204. I didn't do formatting on this or something.
Just click equal and then go back to the number. It should copy it.
Oh, yeah, yeah. Oh, yeah, it was. I have it up here. Oh,
It's
yeah.
a reference.
Okay, so I think that's our only asset, right? There's no goodwill because we're kind of in the opposite. Okay, dividends. This is equity earnings in Chandler. This is a kind of a weird new terminology. Kind of irritating. That's what they call it for whatever why they do it that way. But the equity earning is the same thing as the income from the subsidiary. And now the expenses are that. Okay, so depreciation amortization, okay, so it'd be 34,000. I think that's it. Look just to make sure. S D E. That's it. All right. Now be careful on this one because this gain is going to be a plus. So this is actually a plus. Hey, hey. Yeah, so this one, make sure you remember to put that one in as a positive. Ah. Okay, this will just be all the parent stuff, basically. Liabilities are combined here, so. And the only thing left here are the two. Okay, yeah, those are right. Those are the right. Excuse me. Oh, I never put this night thing up. Ooh. And so I'll put those in Blackboard too. I'll put those in Blackboard so you guys can submit them. And we'll say the due date for both of those is due date, I should say, is 25th.
Yeah, are we turning in just the Excel file?
Yeah, just submit the Excel file, and don't worry about this other stuff in here. These are all part of the other. These are just the first handout. You'll know that these are exactly the same as the first handout. The only problem on there that we didn't do is this one. We could do this one. Maybe we'll do it next time. I don't know. This is one that I it actually didn't have a consolidation, but I adapted it to it.
Okay.
Yeah, so
So we
just,
submit two different Excel files, the one that we started and this recent one, right?
correct. Yep. Yeah, just
Okay.
this. And again, don't worry about this other stuff on there.
Okay.
The I'm looking for is 328 and 333. I should probably save this. Any questions on this thing? So I think we'll do is next week. We'll probably do maybe one or two more of these, and then do a practice test, and then the exam for chapter 3. We'll send out. So what is it? This is week 5, right? So it'll be week 6. And about half the semesters in consolidation. So, and this, and by the way, just so you know that things like this are not, it's hard to do them when we do them, once or twice. Something. If you were working a job doing this, after a couple of weeks, it would be fairly easy for you. Well, weird thing. When I was going through, you guys probably had in your other classes that pensions made no sense to me, the accounting for pensions. And so I worked for Navistar. At Navistar, we had 11,000 employees, and we had 39,000 retirees. We had 35 pension plans. So pensions was really big. So when I was doing internal auditing, we were always, one of the things we ran into a lot was the pension thing. It was so easy, once you're working in it, it makes complete sense. It's just when you're giving it, printed, website or in a book or whatever, it's hard to relate to it, but when you're actually working in it, it's not as bad as it seems. So anyway, so let me go ahead and make the drop for those two, and that'll be it for this week. Turn in those two, the chapter 3 handout and the the problem 328 and 333, just the Excel file if you did the Excel file, or just the regular, however you did it. Just turn it in, and that'll be it. Next week we'll have the practice exam for chapter 3. I mean, we might do another problem or two, but we'll certainly have the practice exam for chapter 3. Any questions? All right, well, have a good week, and I will see you next Wednesday. All right. Goodbye.
Goodbye.
Oh, I'm doing the wrong thing here.
Thank you.
Okay, bye.
Bye.